Okay, good morning. Here we are again, and now we talk about financial analysis. Please introduce yourself. This will be a class about something that you already know. You know how to use all the tools that we've studied in the past months in order to understand, analyze, and express your opinion on the accounts of a company presented in a balance sheet. Okay? So, you know how a balance sheet normally is presented in Italian, the composition of the balance sheet. It doesn't change much, but clearly the terminology, the way that the accounts are shown to investors is different. And that's basically what we're going to see in this YouTube video. So, let's start. You can see this is part of my CLIL course in 2017. It was a more technical course about the how to do financial statements. Some of the topics had not been covered before, so for you it should be easy to understand the economics that are behind these concepts. The English, well, it will come with practice. So first of all, we look at basically the theory. It's kind of a review of all you know. Then, in a separate open Zoom class, I'll present you a case study, and then you will have to elaborate on the case study for tomorrow. Okay? Together, we will discuss it, and then we'll see how you're doing. Let's go. First of all, the stato patrimoniale, okay? It's called statement of financial position, okay? Normally, it's balance sheet, okay? The balance sheet is the stato patrimoniale. Statement of financial position is more used now that the IFRS terminology is in vogue, okay? So if you see statement of financial position, it's referring to a picture taken in a precise moment, i.e., at the close of the quarter or at the close of the year, about the investments of a company in the assets and about how the company is funding these investments with all the liabilities. But here it comes. Clearly, you have a balance sheet that is comprised by two sections. The left and right section here, it's called total assets, okay? And the right hand side part is called total liabilities, attivo, passivo. We call it a classified balance sheet because it's been already reclassificato. It's something that is already being prepared to conduct a financial analysis. As you know, you cannot take a simple balance sheet out of the Camera di Commercio and pretend to do an analysis out of it. You first have to operate some changes to reclassify it, so to classify it, okay? What have we got on the investment side? We got basically two major categories: current assets and long-term assets. Sometimes they are called in English current assets and non-current assets. So the emphasis is on the liquidity of the assets. They usually now start with presenting the most liquid asset first. And then they get to the part of the investments of the company that are harder to liquidate. Anyway, as for any type of analysis. You know that current assets are the assets that change, that they rotate quickly several times in the course of basically a fiscal year, whereas non-current assets, i.e. fixed assets, are assets that stay in the company for more than 1 year. In current assets, we find cash, which includes bank accounts. We find marketable securities, which means usually bonds, short-term bonds, something that you keep there and you use it as a way to put your liquidity in something that has a better yield, a better interest on it, okay? Receivables, inventories, accruals, and prepaid expenses. What are these? Well, think of the stato patrimoniale attivo section backwards, okay? So we have cash, bank accounts, then we got titoli a breve, marketable securities, and then you start to get into the part of the assets, current assets, that are a little bit more difficult to liquidate. Receivables indicates all the crediti verso clienti, okay? Something that you have to receive from the customer, something that you expect to receive at a given time in the future, with a 30, 60, 90 days type of cycle that you have decided to apply to your customers. And that's basically credit that the company is giving to the customers, okay? So receivables, account receivables, is about the credit. Then you got inventories, which is basically the stock of raw materials, unfinished parts, and finished goods. So everything that I keep in stock in order basically to fulfill my business. So that's the magazzino part of the current assets. We then have ratei, which is called accruals, okay? And then we got prepaid expenses. Prepaid expenses that, as you know, we tend to put it into inventories. Yeah, basically the risconti. It's part of the inventory. It's part of something. It's a cost that I've already paid for. It's there. And I will use it in the following year. So this is all current assets. Let's carry on. We get into the most illiquid part of the balance sheet, of the investments, okay? Something that is not easy to move. And unsurprisingly, we have basically 3 categories that are very similar to the way we present in Italy our balance sheet. Okay? We got investments, partecipazioni finanziarie. So basically, if I get a stake in a company, for example, if I acquire a company because I'm interested in the technology and I keep it as a separate entity, I've got this company stock, okay, this investment in the company on the side of assets that are not there to be sold, are there to stay. Then I got plant, property, and land. So the part of fixed assets related to something tangible. My machinery, my buildings, everything, okay? And then, when I talk about brands, when I talk about royalties and everything that is of a kind of immaterial, intangible, it's called, fashion, okay, nature, then I have something which is classified as intangible. We got basically the 3 categories: immobilizzazioni immateriali, immobilizzazioni materiali, and then we got our immobilizzazioni finanziarie. So investments, plants, property, land, and intangibles make up for the hardest part to mobilize, so the less liquid part of the investments of the company. Now, let's switch to the liability side, okay? By the way, dare avere is called credit and debit. So this part is total liabilities is on the right-hand side of the balance sheet, and it's divided in 3 categories that you well know. Current liabilities, basically debts that have a maturity less than 1 year, within 1 year. Long-term liabilities, anything which is debt, so you need to pay it back, which has a maturity longer than 1 year. And then finally, the capital of the company, what we call equity, i.e. the sum of all the monies that the shareholders have put into the company to have it stay there, basically the part of the company, the part of the liabilities that goes out last. So in case of the liquidation of a company, first you pay all the debts, and then if something is left, you divide it among the shareholders. That's the idea of the equity, and it's comprised by the paid-in capital, which is the capital, capitale sociale, riserve, legale, all the other things, plus retained earnings. Retained earnings are basically the autofinanziamento proprio, so the way in which a company finances itself by keeping profits without distributing them to shareholders in terms of dividends, okay? So again, 3 categories that should be very familiar to you: current liabilities, long-term liabilities, and equity. Nothing different from what we do in Italian. The terminology changes. The idea is the same. In this case, we have a different way of expressing things. Let's have a look at some components of current assets. So for example, we got receivables. What's on the other side of receivables? Payables. So something that I have to pay to whom? To my suppliers. So payables are basically debiti verso fornitori. Receivables and payables are basically the part of credit that the company gives to the customer, receivables, and the credit that the company receives from its supplier, i.e. payable. I have to receive some money. That's a credit I have with respect to my customer. I have to pay some money. That's basically a debit that I have with respect to my supplier. That's it. So, as you know, BSA is one of the major companies we have around. It's listed on the stock exchange. As for the fact of being listed on the stock exchange, it has to comply with the IFRS standards, okay? So, all the presentations of the BS group are both in Italian and in English, and they are a very good source of information for anyone interested in getting into the details of how to do financial analysis with something that we pretty much know. Clearly, by looking at receivables, payables, and inventories and how they move, we can get a very interesting analysis of how the business is evolving, the current business, okay? The working capital is evolving. And this is something very important. Let's have a look at the basic total relationships that there are within the statement of the financial position of a company, something that you all know very well. All the assets are equal to the liabilities, so total assets equal total liabilities, always. Okay? It's by design. Double entry bookkeeping, partita doppia, is designed this way. Then we got the total assets are basically formed by two components, as we've seen, current assets plus total liabilities. The total debt is given by short-term debt maturing within 1 year and debt, long-term debt, which is maturing after 1 year. We got basically that the liability side of the balance sheet is given by debt and equity. Debt divided in two parts plus equity. So if you take all the assets, you subtract debt, that's the value of your equity. That's the value of the money that the shareholders have put into the company. And these are all relationships that you know well. They are expressed in a different language, but you know them well. Let's talk about the net working capital, that sometimes in English it's called just working capital. I made a slight change here, just I've added to my slides net capitale circolante netto, which is a key measure of the financial position of the company. As you well know, how do you calculate net working capital? You basically take the current assets and you subtract from there current liabilities. The value that you get is the excess of current assets over current liabilities, or if you prefer, the excess, looking at the other side of the balance sheet, of equity plus long-term debt over fixed assets. So let's have a look at the classical way we express this type of relationship. We got current assets in green, on the other side current liabilities in red. If we have current assets greater than current liabilities, we basically get a net working capital, a positive net working capital, okay? On the other side, if we have a margine di struttura type of look at the company, we have equity, mezzi propri, and on the other side we have long-term liabilities, debt that matures over 1 year from now, okay? So the sum of capitale permanente, so basically the sum of equity plus long-term capital less the value of long-term assets, gives you the same result as before, i.e. net working capital. Whenever you have negative net working capital, you should be very worried about the sustainability of the business. Why? Because if something goes wrong, you might find yourself in a position where you need to liquidate fixed assets that by their nature are very liquid assets in order to pay your debt. We have a look at BSA. Again, you can have an idea about how things are moving to BSA, and you can see how they all were basically during the period considered, they've always kept a positive net working capital. We can start talking then about some analysis about what we look for when we analyze a balance sheet, and it's about working capital ratio. So something you already know. We were already talking in English, calling them in English when we were studying them in Italian, okay? Current ratio, so current assets over current liabilities. The quick ratio, current assets less inventories over current liabilities. And then the cash ratio, which is cash plus marketable securities, so basically really cash on hand, over current liabilities. These are all indicators that you well know, okay? Obviously, you have to learn how to express them in English. Talk about a balance sheet by using the English language. But these are concepts that you actually should be pretty familiar with. Then we got basically kind of ratios that you can use in order to see what's the position of the company looking at the liability side. So, for example, you can see what are the total debts, so current debts plus long-term debts, over the total of the assets. And they give you an idea about how much of the company is using in terms of external sources of funding. No, it's not using equity. Basically, the more the company is capitalized, the less the risk of bankruptcy. Why? Well, because if you have a 80% equity to asset ratio, you have only 20% of that. It will be very easy, even if you think about conditions of critical situations like the ones we are living right now, you can basically think of a way probably to refinance your 20%, or you can liquidate assets. So these are concepts that should be very, very familiar to you. Let's look at one of my favorite companies in the world, that is Ferrari. This is basically the debt and the liquidity position of Ferrari in a way that the company decides to present itself to the financial community. So basically, you see that, first of all, it shows you what is the future in terms of when the maturities of Ferrari outstanding debt are there. So this is something produced in 2017. We have basically maturities that go further to the 2023 time period, okay? So you know when the company will need to find liquidity in order to pay back these loans. It tells you also how the company is basically managing the liquidity. The different currencies, because Ferrari sells just a very small part of its total production to euro-based customer. It's certainly a minority part with respect to, for example, all the customers in the USA, all the customers in Asia, and so on. But clearly, Ferrari is based in Europe, and it uses euro as the major currencies because it has to pay, for example, workers in euros. It has to pay all the suppliers in euros. Well, still, they give you an idea about how they use currencies. And anyway, this slide that is taken directly from the company presentation gives you a perfect idea of how a very good and successful company such as Ferrari is presenting its liquidity position towards its investors. Let's go back to Pesaro and to BS. So this is, for example, the statement of financial position as highlighted by the BS balance sheet, okay? So it has a kind of different way of exposing, okay, basically it has a different way of exposing the balance sheet in terms of just putting it as a kind of classical version, Italian version, i.e. from the most illiquid asset to the most liquid security. Again, you can have a look at how things have moved. Notice that total of fixed assets is called non-current assets, okay? We have a net working capital and then net investment capital, the total investments of the company, the total assets of a company. that you can compare them. Okay, this is basically total of the impieghi of a company with the total of fonti, total sources of funding. So this is interesting because here you have an Italian company that is presenting the balance sheet in an Italian way, but in English, okay? They have changed it. Still, it's interesting and it's perfectly fine. Let's get to the second part of the balance sheet. After the financial, the statement of the financial position, we all know that we have to look at the conto economico. And how conto economico is called in English? Well, we got income statement, okay? So by income statement, we refer to the part of the accounts where you have revenues minus costs in order to determine whether you make a profit or a loss, okay? We have already discussed at length in class that usually when we are talking about US companies, they prefer to use a different type of exposition with respect to ours. So they don't have very much a value-added income statement. They have something which is basically a cost of goods sold type of approach. So we have different ways of expressing the same thing with different intermediate results, as we all know. Let's get into the details of some of the way you express your income statement. So, sales plus interest income plus other income means total revenues. We all know that the top line is called sales, okay? Top line. Why? Because with this type of way of expressing our profits or loss, we start from all the revenues and then we subtract all the costs. So basically we start with the top line, which is probably the most important and less manipulated item of the balance sheet, which is the amount of sales that we made in a given period. Then we can add other revenue. We might add some financial result, and then we subtract all the costs. This is called single step income statement. So, for example, interest income is put above. We don't do this, okay? It's not the only way they do it. This is something instead closer to what we are used to. For example, we have net sales minus the cost of the goods that we produced and sold, and we got the gross margin, which is the classical indicator that we use, and we all know that for industrial companies this is a critical element, okay, in determining the potential profitability of the business. Again, net sales are difficult to be influenced by policies that tend to increase them or decrease them artificially. Gross margin, we all know, is more, how to say, it's possible to manipulate it. Then we got into operating expenses, OPEX, and at the end of the day, well, we get to finally the EBIT, earnings before interest and taxes, operating income, reddito operativo. We all know EBIT by our previous studies, minus the financing costs. We get basically earning before taxes or gross profits, and then at the end, minus taxes, we get net income. These are all things you know. You just have to understand how to use English terminology in order to express yourself when you're doing a financial analysis. So this is basically the type of things that we have already seen in class. We were not calling them maybe with these names, but the idea and the concept is always the same. Okay? Just remember that in Europe we have a tendency to present statement of incomes with a value added type of formulation. It's the opposite is true for US based companies. So, what are the major values that we can get from an income statement analysis? Well, top line, gross margin, EBITDA, which we know is a proxy for operating cash flow, depreciation and amortization. We all know what it means. We get to EBIT, okay, earnings before interest and taxes, and at the end of the day, we got gross profit less taxes, which depend on the jurisdiction where your company is based. You get to net income or profit. Okay, so gross profit minus taxes, net income, profit, gross profit. Everything here should be known to you. You just have to get used to the way you express the concept you have in your mind. Let's have a look at the BS again in this way. It starts with a top line, some adjustments, it gets to revenue, and after taking out external costs, you know, we have an added value type of measure, which is the first time we've seen it. Why? Because BS is basically converting its Italian European way of presenting an income statement into an English language document. You get to EBITDA, which they call here gross operating profit. Then we get to EBIT, and then we got to gross profit, and then we get to net income. This again is a way of presenting in a very interesting way, in a comparable form, directly quarter on quarter. So Q4, fourth quarter of 2016 with respect to fourth quarter of 2015. With respect to, instead on the right hand side, we have the full year 2015 with respect to the year 2016. We got basically all the major indications that we get from a financial income analysis. So revenues, EBITDA, remember EBITDA, proxy for operating cash flow, EBIT, financial expenses, basically net effective tax rate, profit, and basically earning per share. EPS is earning per share. Why? Well, because the company is listed in a stock exchange, and this is something which is very useful to make comparison between Ferrari, for example, and a competitor in the luxury segment. So, gross margin is hard to massage. Why? Because sales is very hard. We know that there are ways to increase or decrease gross margin. EBITDA, which is the proxy for operating cash flow, and clearly EBIT, which is a very important metric, especially for the type of analysis that is required by the Ministero for you. But again, we know that, well, it has some issues. Still, EBIT is used in all the major indices. These again are some slides taken out from the balance sheet published by BS and all the accompanying notes and relation by the management and so on. You can see how the company moved from a loss in 2009 due to the financial crisis to very good results. It will be interesting to see what happens clearly. So this is the BS EBIT. And then we get into some analysis of the profitability, i.e. we use ratios, something that you know very well. So return on investments. Return on investment, we got operating profits over total assets. Why is this important? Because operating profits are not influenced by the liability structure. So operating profit are not affected by the amount of interest expenses that the company is paying. So let's say you are comparing two competitors. One is heavily indebted and the other one is instead has a very solid equity base. The analysis of the operations of the companies, if you stop at EBIT, allows you basically to avoid the effect of the different degree of indebtedness, so the different amount of debt and interest that the two companies have. This is a decomposition that we all know, okay? And for what basically we know, EBIT over sales is ROS, and then we got sales over total assets, which is the turnover ratio, something that you well know. We moved into ROE, return on equity. So here we have got a classical decomposition of return on equity. We know that there are other decompositions, such as the DuPont decomposition. But for example, let's stop here. We got ROI. We got here total assets over equity, which we all know what that means. How many times you are investing €1 of equity, so a leverage measure. And then you got net income over EBIT, which is basically that amount, that index, that is very much dependent on the structure of the company in terms of tax jurisdiction, in terms of the ability of the company to generate revenues with non-characteristic assets and so on. So this type of indicator, which is more worrying when it's closer to 1 than anything else, because it tells you that there's something to look into it. Then we got clearly the analysis of the leverage effect. So leverage, which is the way that the liability structure of the company influences basically the profitability of the company itself. If I have a cost of funding, so a return on debt of 5%, and my ROI, return on investments, ROI, is 12%, clearly I have 12% minus 5%, I have the potential of getting a very positive leverage effect. Okay? Clearly, the higher we put debt in the company, the higher the leverage and also the higher the risk. And we know that this is a very important effect. We all know this analysis of the gross return on equity, so excluding taxes and excluding extra characteristic revenues, which is basically given by the return on investment plus the ratio of debt to equity multiplied by the difference between the return on investments and the cost of debt, which is called ROD. Okay? All things that you know, you just know how, you just have to get how to express them in English. This is an interesting slide published by BS, which is the ROE 3. So it's basically a type, it's called simplified, but it gives you a nice idea of how the company, at least until 2016, had probably a CFO that was thinking in exactly the same way as you are thinking, given the type of debt of the course that we've studied. So you have a return on equity, which depends on the leverage, on the return on investments, on the return on sales, and on the turnover ratio. We then switch to cash flow, that we know it's typical of the rendiconto finanziario. Okay, it's called cash flow analysis. We know that cash flow analysis can be very tricky, but basically we have three components in the cash flow analysis. So we got operating cash flow, financing cash flow, and then investment cash flow. Okay, so these three components determine the variation of net cash available to the company from one year to the other. These are some of the major metrics that are used by the companies when they try to understand and make comparisons between, for example, company A, B, and C. You can look at the cash flow yield, i.e. operating cash flow over net income. You can use the cash flow to sales or cash flow to assets. So these are clearly some cash flow measures that are useful for companies listed on the stock exchange. But again, the basic you have to know is that in a cash flow analysis from a cash flow statement, you get three components: operating cash flow, financing cash flow, and investment cash flow. The sum of the three is the change in the available cash resources to the company between year one and year two. There's another concept which is very important, which is the free cash flow, i.e. the cash flow that the company has in order to use it regardless of what has to do in terms of future investment. So it is actually the company available, cash available to the company to use it, okay? Once you have fulfilled all your commitments due to the industrial plan. So if you plan to buy a plant for €1 million in the current year, clearly you have to subtract that €1 million to the cash flow that you generate. Why? Because that cash flow will go into the plant. What is left, the free cash flow, is actually what you can do. You can use it for anything you like expansion, like dividends, like buybacks, like whatever you need. And it's a key measure to understand exactly the degree of freedom that the CFO has in terms of using the cash flow generated by the company. This is the cash flow of Ferrari. So cash flow from operating activities, cash flow from investing activities, and then you got the part of free cash flow, as I said, depending there, and free cash flow from industrial activities. You then have to add the part connected to clearly to funding. I'm basically ending my presentation here, so you got it on Moodle, so you can go there, download it, analyze it, study it. These are the sources of my presentation. And with this, I finished. We are basically on time. I would say that we close right here the YouTube session, and we proceed at 10 o'clock sharp with a Zoom meeting about what I've just explained. We can then see each other, let's say at 5 to 10 on Zoom. Okay? Use the invitation that I've sent you yesterday. Bye-bye.